Hello and welcome back. In this part of the video, we will be learning details of the type of activities. In the previous video, we just learned there are three basic cash flow is categorized into three basic activities: cash from operations, investment activities, and financing activities. So let's look at it more detail. By the way, just to let you know, there are two ways of preparing the cash flow. One is direct method, one is indirect method. Now, direct method means that we will be starting from we will be going directly into how much cash did we collected, and then how much cash we paid, how much cash we spent out to the for the operation activity, how much cash we did actually paid for the investing activities. The major difference is between direct and indirect method is to see how we generated the cash from operations. Basically, it's not so much on the investing and financing activities, mostly from the cash from operations. So in the direct method, cash from operations is derived from collecting sales collections minus cash paid to suppliers, then the inventories, purchase, and all those kind of things. While indirect method is more easier, it just take into account net profit and then changes in the working capital. So we'll be looking at indirect method as this is the most used method in published financial statements. Cash from direct method is mostly used for interim financial reporting. It's a more detailed version of how the cash has been coming and going out of the company. But indirect method is a bit easier and easy to understand as well. So let's look at the cash flow statement now. This is indirect method again. Is derived from the profit. So the profit is taken from the balance sheet, what was the net profit, and then it has been adjusted to add back the non-cash items. So what are the non-cash items? Here you can see the company has added back $16,000, which is non-cash because there's no spending in cash, right? Some of the activities from like joint venture or profit and loss from the sale of fixed assets, they are added back to they are removed from the cash generated from operations. Reason being is they will be covered in the financing activities or investing activities. So this is how we do these kind of this is how we recognize the cash flow. So sorry. Now and only the profit is considered. The actual cash collected will be shown in investing activities. Now they have added also the profit on sale of stake. I mean, again, is going to the investing activities, and then gain from financial assets is also removed. Dividend income, interest income, finance income, they are all related to the either investing activity or to the financing activity. That's why even the interest paid also is added back to the operation. So you can say operating profit before working capital changes. So this is the capital, this is what we will gonna be using in terms of calculating cash from operations. So now increase or decrease. So this is in decrease in the trade payables means that trade and other receivables is actually increase. Trade and other receivables. So whatever is the changes from the previous year, it will be. So let's say there was an increase. We saw that there was an increase in the balance sheet, right? Let's see that one. In the balance sheet, we see that the cash receivables, the trade receivables are increased from 8,000 to 17,000. So there is an increase of 9,000 in here, and then there's an increase in other loans and advantages, and then there is a increase in other current assets. So this means that we have recorded the sale in credit, so but we have not actually collected the money. That is why the difference is deducted from the cash flow statement, because it's part of the profit, right? You have not included, you're not able to collect that money, so this is why it is deducted. Inventory is also increased, so that is also is reduced from the cash from profit operations. But at the same time, trade and other payables are also increased. So means that we have paid for the suppliers. We bought the material and we booked the expenses, but we haven't paid the suppliers. So the cash generated from operations is much more than what is supposed to be the profit, what is called profit. So here is 81,000, and then we paid the taxes out of this net $9,000. Now the cash from operating activity is 71,000. Now you see net profit shown in the profit and loss statement is 49,000, while cash actually generated from operations is 71,000, which is far better, which is better actually, because it means that because the primary reason here is also because of the increase in the trade payables and also increase in the depreciation. Now coming to the investing activities. Investing activity means sale and purchase of the fixed assets or your investments. So here you can see the company has purchased 73,000 worth of property, plant and other intangible assets, and then minus the profit or sale from the purchase proceeds from the disposal. Now here we saw we removed the profit. Here we see we added back the whole disposal. The cost is not considered in here, right? Purchase of investment and sale of investments is also because the company keep on buying and selling the investments. So this is also reflected in investment activities. Then maturity of the fixed deposits means and interest income, how much interest income they have received, how much dividend they have received from the investments. So here you can see the company generated 71,000 from the operations, and it invested that money into the property. So here 68,000 is minus. So this is how the company has been utilizing its cash from operations. Then there is another part, the last part, which is called financing activities. Now, financing activity means all the interest, the one that we have taken from the borrowings, or we return the loan, we take the new loan, we raise new capital, we pay dividend. All those cash activities are coming here. So here you say proceeds from issue of share capital, non-controlling interest, minority interest, new share application money, proceeds from the borrowing. So they take a loan and then they repay some loan, and then borrowings, current, how much is the increase in the current borrowings, and how much is the interest paid out of for these cash. So in net, the cash actually is used in the financing activities primarily because of the interest, it's look like, right, and the dividend, $2,000. So this is how the cash generated from operations has been used. Cash generated from operation was 71,000. Out of it, 68 was used in the investing and $2,000 were used in the financing. So opening balance was 1,000. So the net cash generated during this year was 1,000. Opening cash was 2,900. So the closing becomes 4,200. Compared to the previous year, the cash was actually not generated. It was used. A lot of cash was used. We can see primarily because we were able to generate only 49,000, but we invested a lot in 66,000 in the investing in the fixed assets. Now, where this money came from? This money came from the borrowings. Here you can see we didn't pay a lot of interest, and we raised a lot of money, 31,000, and we repaid also some. But in a nutshell, we raised current borrowings, we raised previous year because there was not enough cash generated. So this is how you read the cash flow. You understand how the company is being investing. So the money, now in this particular case, even though the cash sitting is not too much, but there are a lot of investments in the company's balance sheet, which is non-current, which can be sold at any point of time. So it's not that company does not have cash. It's just that it is being invested into other investing activities. So cash flow will give you a flair of what is happening within the company's interest. If let's say there is a manipulation of revenue, the collections, the debtors increase, so it will hit here, so it will be reduced because it's increased, right? So the cash from operations is going to reduce. whatever is the profit. So the cash from operations gonna be reduced. So you can always see the difference. What is the difference? Is it companies usually the net profit versus the cash from operations is always more than the net profit. In case it's lower, there is a problem because it means that the company probably is booking fake profits. So that was all about the cash flow. If you want to understand, if you are not clear about anything, just post your question and then I will be happy to answer. And this was all about the financial statements, what we needed to learn from the balance sheet, assets, and profit and loss and cash flow ratio analysis. In the next section, we will be looking at the business performance controls. That is off the topic for this, a little bit off the topic, but it's important section. If you have any questions related to the financial statements, please do post your questions in Q&A and I will be happy to answer them. Thank you very much and looking you forward to the next section. Thank you.